We don't need cars from Canada. We don't need energy from Canada. We don't need anything from Canada. But if you make the auto industry bigger, better, stronger, you don't have to worry about Detroit. It'll be very good. It'll come by its own.
Detroit's auto industry thrives on the strength of Japanese brands like Toyota, Honda, Nissan, Subaru, Mazda, Mitsubishi, and Suzuki. These 7 major players employ roughly 500,000 workers across the United States and generate $170 billion in annual sales, powering local economies from coast to coast. Now, the White House is considering a bold move, a 25% national security tariff on these vehicles, citing Section 232 of trade law. If this tax goes into effect, it won't just raise prices at car dealerships. It will send shockwaves through the entire supply chain, impacting businesses from Ohio's seat manufacturers to Alabama's steel mills. So, who stands to gain, and who will bear the brunt of this risky policy? Let's dive into the latest global developments and unpack the implications together. Be sure to subscribe to our channel, hit the notification bell, and like our videos to stay updated with our content. The discussion around a 25% tariff has evolved from a distant diplomatic issue into a pressing economic challenge with real-world consequences. Since late 2024, negotiations between Washington and Tokyo have grown increasingly tense, shaking not only government policy rooms but also thousands of supply chains, stretching from Detroit's bustling assembly plants to Texas, Alabama, and rural Kentucky. The core question is, what happens if the White House imposes this tariff, arguing that Japanese auto imports pose a threat to national security? From morning reports at investment banks to lunchtime meetings with union representatives and evening briefings with retail finance analysts, everyone is grappling with the same concern. If these 7 automakers, Toyota, Honda, Nissan, Subaru, Mazda, Mitsubishi, and Suzuki, scale back production or exit the US market entirely, how many jobs, dollars, and points of economic stability will be lost? Japanese automakers have built a massive presence in the US, contributing $170 billion in gross sales, $47 billion in added economic value, $1.02 trillion in related industry activity, $93 billion in payroll for workers, and a staggering $1.3 trillion demand chain when fuel, maintenance, and service costs are factored in. Think of it like a small business boom in one country lifting the housing market in another. Auto manufacturing in the US acts as a powerhouse, driving countless industries forward. From steel mills producing raw materials to logistics companies transporting parts, from small upholstery workshops in Ohio crafting car seats to innovative startups in Las Vegas developing aftermarket software. The impact of this industry extends far beyond the cars rolling off the assembly line. It's a complex ecosystem that supports communities and businesses nationwide. In 2023, Toyota Motor North America produced 1.25 million vehicles at its plants in San Antonio, Texas, Georgetown, Kentucky, and Blue Springs, Mississippi. Honda manufactured 970,000 vehicles at facilities in Lincoln, Alabama, and Marysville and Anna, Ohio. Nissan built 770,000 vehicles at its plants in Smyrna, Tennessee, and Canton, Mississippi. Subaru produced 221,000 vehicles at its Lafayette, Indiana facility. The Mazda-Toyota joint venture in Huntsville, Alabama, churned out 150,000 vehicles. Mitsubishi, which ceased production at its Illinois plant in 2016, still supplied 75,000 rebadged vehicles through strategic partnerships. When you add in imported vehicles that reach US dealerships, Japanese brands sold a total of 6.32 million units in 2023, capturing an impressive 43.6% of the US market for passenger cars and light commercial vehicles. Looking at sales data from the past 2 years underscores the high stakes of this potential tariff. In 2022, the Toyota Lexus Group sold 2.1 million units. Honda Acura sold 1.22 million. Nissan Infiniti moved 783,000. Subaru sold 556,000. Mazda delivered 294,000. Mitsubishi sold 102,000. And Suzuki accounted for 65,000 motorhomes and motorcycles. In 2023, several factors, a recovering global microchip shortage, surging demand for mild hybrid vehicles, and rising gasoline prices fueled a boom in the compact SUV segment, driving sales even higher. Toyota Lexus reached 2.28 million units, Honda Acura hit 1.34 million, and other brands like Nissan, Subaru, Mazda, Mitsubishi, and Suzuki saw significant increases as well. With an average dealer price of $38,650 per vehicle, Japanese brands generated a massive $169.7 billion in revenue in 2023. Taxes from these sales, including corporate income tax, state sales tax, federal payroll tax, and Social Security contributions, pumped $24.8 billion into the U.S. economy. When you include non-tariff taxes from domestically produced parts, energy costs, and infrastructure expenses during manufacturing, the total tax contribution climbs to $31.3 billion. This revenue could fund multiple years of education or healthcare budgets in key auto states like Ohio, Alabama, or Kentucky, supporting vital public services. The critical question now is whether these automakers can remain profitable if a 25% tariff is imposed. Since the 1980s, companies like Toyota and Honda have invested heavily in U.S. production, using significant amounts of locally sourced parts to reduce costs and build community ties. For example, the Tundra and Sequoia lines in San Antonio use 65% North American content. The Camry and RAV4 lines in Kentucky use 72%. Honda's Civic production in Marysville uses 68%. Nissan's Rogue and Pathfinder lines in Smyrna use 58%. And Subaru's Lafayette plant uses 52% domestic components. In the 2024 fiscal year, Toyota's North American operating margin stands at 7.1%. Honda's at 5.6%, Nissan's at 4.3%, and Subaru's at 8.8%. Adding a 25% tariff on top of these slim margins could push these companies, which are already absorbing higher costs for hybrid engine technology, into financial losses. As a result, scenarios like scaling back U.S. operations or freezing new investments are becoming real possibilities for their strategic planning teams. The potential impact on employment is staggering. According to data from the Bureau of Economic Analysis and the Automotive Alliance for Innovation, Toyota supports 35,200 direct jobs and 90,400 indirect jobs in the U.S. Honda employs 28,100 direct workers and supports 61,000 indirect jobs. Nissan accounts for 18,500 direct and 47,600 indirect jobs. Subaru has 6,900 direct and 14,800 indirect jobs. The Mazda-Toyota joint venture employs 4,800 direct and 9,200 indirect workers. Mitsubishi maintains 1,700 direct and 3,200 indirect jobs through its parts and service distribution network. Suzuki supports 900 direct and 1,400 indirect jobs. In total, these companies account for approximately 436,000 jobs, including 96,000 blue-collar direct jobs, 227,600 indirect jobs, and 113,000 induced jobs in related industries. Additionally, there are 17,000 white-collar workers employed in consumer credit and leasing offices, such as Toyota Financial Services, Honda Finance, Nissan Digilend, and Subaru Capital. When combined, the total job count exceeds 500,000. Based on 2023 Bureau of Labor Statistics wage data, these jobs generate $93.1 billion in annual salaries and benefits. Automotive manufacturing accounts for 11 to 22% of total manufacturing employment in 8 U.S. states, meaning a withdrawal of Japanese manufacturers could push regional unemployment rates up by 2.6 percentage points in states like Mississippi, where the labor pool is limited, and by 1.8 percentage points in Alabama's industrial heartland, causing significant economic disruption. The tariff could also create a substantial gap in federal and state budgets due to lost tax revenue. The Congressional Budget Office estimates that if Japanese automakers' U.S. sales drop by half within 3 years due to the tariff, federal revenue could fall by $18 to $21 billion in 2026 and $26 to $28 billion in 2027, based on historical data from the early 1990s following the Plaza Accord. This loss includes not only corporate and payroll taxes, but also fees from port operations, logistics, and dealer franchise agreements. Over the first 3 years, the cumulative loss in taxes, fees, and premiums could range between $58 billion and $62 billion. The Georgia Tech Logistics Institute's multiplier model suggests that only 40% of the claim that American, Korean, or European brands like Tesla, Ford, Hyundai, or BMW would replace the lost Japanese sales volume will hold true. The tariff shock would inflate the supply chain and increase inventory turnover, meaning that while half of the customers lost by Japanese brands might switch to other manufacturers, the other half would likely postpone purchases or turn to the certified used car market due to higher prices and financing challenges. This would shrink the overall production and investment base, further weakening the economy. Beyond direct economic impacts, the tariff could disrupt the broader financial system. Japanese companies are major players in the U.S. bond market, holding $1.06 trillion in 30-year Treasury bonds to maintain a stable yen-dollar exchange rate around 150 during this inflationary period. A tariff could deepen the real interest rate differential, disrupting portfolio flows that suppress the yen's value and reduce dollar-denominated reserve purchases. Even a small unwinding of 5 to 6% of this bond stock would force the Federal Reserve to create additional demand for its fall coupon auctions, potentially pushing 10-year Treasury yields up by 30 to 45 basis points. This could erase the estimated $78 billion in customs revenue from the tariff if borrowing costs rise unexpectedly, as seen in the Davos spread reaction in June 2024. Moreover, the tariff threatens to unravel 30 years of U.S.-Japan technical collaboration, which has been a cornerstone of American manufacturing efficiency. The Toyota production system and Honda's flexible assembly lines have introduced lean manufacturing techniques like just-in-time, Kaizen, Andon, and Gemba, training 197,000 U.S. workers in the ancillary industry. These methods have transformed subcontractor facilities from Tennessee to Alabama, boosting productivity and quality. If Japanese automakers shift production to Mexico, Canada, or their home markets, U.S. suppliers could face a reverse industrialization crisis, with order books drying up and new investments needed to meet the standards of European or Detroit-based manufacturers. This could erase decades of production expertise, affecting everything from vacuum melting lines in steel foundries to sensor cable installers. The ripple effects would extend to educational institutions, from machine technician courses in North Alabama to materials engineering labs at Purdue University in Indiana, disrupting training and innovation pipelines. On the global stage, the tariff could strain U.S.-Japan relations, a critical alliance for trade, diplomacy, and security. Japanese firms might respond by reducing U.S. investments or shifting focus to markets like Europe or Asia, weakening America's position in the global auto industry. Competitors like China or Germany could seize the opportunity to expand their influence. Additionally, the interconnected nature of global trade means a U.S. tariff could prompt retaliatory measures, such as higher tariffs on American exports like agricultural goods or technology, further complicating the economic landscape. In short, a 25% tariff is not just a tax on imported sedans. It risks disrupting a complex economic ecosystem in one fell swoop. If Japanese automakers exit the U.S., it could eliminate 500,000 jobs, tens of billions in tax revenue, $1 trillion supply chain multiplier, and a critical catalyst for innovation. While it might appear to reduce the trade deficit on paper, it would likely increase bond yields, logistics costs, used car prices, consumer loan payments, and inflation expectations in the real economy. Over the long term, replacing Japan's lean, mistake-proof production systems with high-volume, high-inventory, less flexible models could undo 30 years of gains in U.S. industrial competitiveness. Even in the worst-case scenario, where Toyota, Honda, Nissan, Subaru, Mazda, or Mitsubishi shut down U.S. operations due to zero demand, the American auto industry won't grind to a halt overnight. However, the gears will slow, regular maintenance will be neglected, and fixed costs will rise, creating a drag on the economy. What are your thoughts on this issue? Share your opinions in the comments section below, and don't forget to subscribe to our channel.